He said, you're employed by Bolade VP, a very large printing firm with retail outlets across Nigeria. Its board is considering making an offer to buy 100% of the shares of Kenny Limited KL. So you have a company PP trying to buy another company KL. So that's the crux of what this question is all about. One company trying to buy another company. That's the primary focus. Okay. Then says KL's financial year end is 28 February, and its most recent financial statements are summarized below. So you have right below, you have the financial statement for the company that Bolade wants to buy or wants to acquire. So these are the financial statements. So these are the income statement of the company it wants to buy. This is the statement of financial position or the balance sheet of the company Bolade wants to buy. Then we have additional information. KL's management have some of the company's assets independently revalued in January 2023. Those values are shown below. Yeah, so they got an independent valuer to say, okay, our land and building, can you tell us what the current market value is? Don't just tell us what we have in our books. Can you tell us what the market value is? Then states the average price earning ratio for listed companies in the printing industry is 9%, and the average dividend yield is 6%. The cost of equity of businesses in the printing industry, taking account of the industry average level of capital gearing, is 14% per annum. So apparently from this statement, we're looking at industry information, and we're looking at ratios for listed business. So what that basically tells us is that the company that Bolade wants to buy is not listed. So we're looking for, we go into the stock market and look for data on listed businesses that are into the same industry, which is the printing industry. And we use that information to make our judgment. So just take note of that. KL's finance department has estimated that the company's pre-tax cash inflows after interest for the next 4 trading years ending 28 February, before taking into account capital allowances, would be as follows. So these are the expected cash inflows from the business. KL Limited existing equipment has tax written down value of 3.6 million at 31st December 2023. The company attracts 18% reducing balance tax allowances in each year of ownership by the company, except in the final year. You should assume that KL will not be purchasing or disposing of any machinery in the years 2024 to 2027, and it will dispose of the existing equipment on 28 February 2027 at its tax written down value. Key information. Bolade's board estimates that in 4 years' time, that is 28 February, it could, if necessary, dispose of KL for an amount equal to 4 times after its after-tax cash flow, ignoring the effect of capital allowances and the disposal value of the equipment from the year to 28 February 2027. Assume that the company's income rate is 21% per annum required. Using the information provided, prepare a report for Bolade's board. It's a report for Bolade's by calculating the value of 1 share in KL based on each of the following methods: net asset basis, historical cost, net asset basis, revalued, price earning ratio, dividend yield, present value of future cash flows. Explain the advantages and disadvantages of using each of the 5 valuation methods in A. What are the possible benefits from the merger between Bolade PLC and Kenny Limited KL. So let's be very quickly sure that you understand the gist of the question. Bolade is interested in buying Kenny PLC. And the main crux of the question is they're interested in knowing what is Kenny PLC worth? What is the value of Kenny PLC's shares? What is it worth? So that when they are making a proposal on the acquisition, they're not proposing much more than what the company is worth. So they're trying to find out what is the company worth. And they want you as a strategic financial manager to tell them, can you tell us what the company is worth based on the net asset basis using historical costs? When we say historical costs, we're basically saying the values that you have recorded in the books of account. That's what we're interested in. Can we calculate what it is based on the revalued position? When we say revalued position, we're basically saying you've gotten an independent valuer to look at the assets and tell you what's your asset worth, what are these worth. Can you factor that in and tell us what the revalued position is? Can you tell us the value based on the price earning ratio, the dividend yield approach, and present value of future cash flow? So that's our purpose, our question. But don't remember that the key part is that we should present it in a report. So whenever you have a question asked, that you present your answers in a report. Now, there are key elements that you must take into consideration when you come to your report. So let's quickly highlight those key elements, and then we come to our calculation, but it's a report. Okay. So report. Whenever you're presenting a report, you should have the two columns. In other words, who is the report going to? Who is the report going to? You should have the from, which is you as a student now. So, or let us assume you're an accountant, maybe the strategic financial manager for Bolade or the chief accountant for Bolade. So just give yourself give yourself a very fancy role. Except the question specifically mentions what your role is, that then use that role. But if the question doesn't mention what your, for example, the question says you as an accountant or you as a manager, so you can just call yourself manager. But the question doesn't tell you what your specific role is. Just look for one fancy finance role and give yourself. You also want to put it in place the date of the report. So for this, you can use the exam date if you want to, or you can use the account date. You can use the date that you have on the financial statement that's given to you, or you can use your exam date as a date. Either of these two it's accepted. What we're really interested in is whether you can present the report in a proper format. And then you would then have a subject. So whatever the subject is, I have my header crossed out. And then you'd have a brief introduction, one line introduction, it's fine. Highest 2 lines, where you mention what the report is about. So please, what is the format you want to take whenever you have your stuff. So you can then go ahead and present your answers. If you need to show workings separately, you can show your workings completely separately. Okay, right. So let's do that for this our question. So to who? The question here says, prepare a report for Bolade's board. So that is who the report is going to. Prepare a report for Bolade's board. So let's quickly begin to plug that in so that we have our report full. Okay. So let me this is just for explanation. I want to solve my question now. So let me just cross out this. Okay. So let's solve it. Let's solve our question now. Just in case you just need this, you need to start as a recap for you. Okay, so two, see Boladi's board. So we can see the board of directors, Boladi, is it limited or PLC? I will confirm that. The board of directors. Be cautious of my time, okay? The board of directors. Is it Boladi PLC, Boladi Limited, or Boladi Enterprise? What's the name? That's the name, that's the full name. Okay, Boladi PLC. Boladi PLC. The board of directors, Boladi PLC. Okay, so that is two. From who? So does it tell us what your role is? If it is not, we just look for one fancy role and give ourselves. You say prepare the report as the accountant, prepare the report as the manager, prepare the report as anybody, the finance department. Okay, so it doesn't tell us who we are. So let's give ourselves a fancy role. So we can say the strategic financial manager or the accountant, whatever you feel like giving yourself. But we're in SFM, so I call myself the strategic financial manager. Strategic financial manager. If the question is specific on what your role is, please make use of that particular role. Please take note of that. The date, you can use the exam date, or you can use the date of the account in the question. So let me, since today is not exam date, let me just use the date of the what do you call it? The account in the question, which is 28 February 2023. That's the date of the account. You can use the exam date if you want to. Okay, so 28 February 2023. And then we can have our subject. What is this report about? Then look at what the requirement of the question is. It tells us what the report is really about. It says, calculate the value of one share in KL based on each of the following methods. Okay. So we can subject it KL share valuation, per unit share valuation, whatever we want to. We can KL possible per unit share valuation. Per unit share valuation. Okay, so we can then have our introduction. Okay, so the introduction is basically just a one line. What is the report about? So what is the report about? In that, what is the requirement of the question? Calculate the value of one share in KL based on each of the following methods. So we're looking at the value of per unit share in KL based on those methods. So this report, we can just say this report presents. This report presents the per unit, or I can use just tie it to the header, the possible per unit value of KL based on, okay, so what are the methods? The methods are net asset basis, historical net asset basis, revalued price earning ratio. Let me just write those ones out first. Based on net asset basis, bracket, historical, net net asset basis bracket revalued price earning ratio. Okay, I think I remember dividend yield, but I can't remember the last one, so I need to reconfirm the last one. Dividend yield, and what's the last one? Present value of future cash flows. And present value of future cash flows. Okay, so that's our format. So that's pretty straightforward. We can then begin to go into them one at a time. So we'll begin with the first one, which is net asset basis historical. Get historical. Do we have any question or clarification we want to seek on the presentation format for our report? Because that's something you need to know for questions that might involve that you present the report. Okay, if there's none, let's get right to okay, so there's none. Let's get right to our different methods. We'll begin with the net asset basis historical. So I'll make some explanation in another sheet, and then I'll come back and we solve it so that I don't mix up our solution with my explanation, given that this is a report. So let's go down and do a quick explanation on net asset, and I will come back and solve it by looking at the question itself. So let's begin with our net asset. Okay, so when we say net asset, we're basically saying that out of what the company owns, what funds or resources is available to the owners of the business. That's what I mean by net asset. It is available not to creditors, not to those you borrow money from, not to those your suppliers. What is available to the owners of the business. So how do we determine what is available to the owners of the business? It is one of two formula. You can come from the asset approach, which would be your total assets and your total assets would be your long or your non-current assets, which is your fixed assets, if you still use the old terminologies. So that will be your non-current assets plus your current asset minus your total liabilities, which would be your non-current liability plus your current liability. Now that's one method. The second method would be your share capital plus your retained earnings or reserve. Then there was what is also called reserves. Now the question says calculate the net asset based on historical cost. Now when we say historical cost, we're basically saying based on your balance sheet. Your balance sheet values. Okay, so those are our net assets. So let's go back to our question quickly and solve what our net asset what the value per share would be based on the net asset approach. So we're going to focus on historical costs. We're going to our balance sheet. So our net assets would be our total assets. That if you want to use the first approach, or you can just say share capital approach reserve, depending on which approach you want to use. So that's our total assets minus our total liabilities. Okay, so let's go to our question and get these values. Let's go to our question and plug in these values to get our total asset. But don't forget, at the end of the day, we need to find the per unit of each of them. So per unit. But let's first see what the total asset is. Then we can then find what the per unit is. So I'm going to our balance sheet because it's historical cost, which is our statement of financial position. Okay. So our non-current asset is 8.8. That's our non-current asset. Our fixed asset is, sorry, our current asset, our non-current asset is 8.8. Our current asset is 6.3. So let's bring in those two first. 8.8, 6.3 gives us our total assets. So our total assets is 8. Sorry, what am I doing? What am I writing? 8.8 plus 6.3. That's total asset. Our total liability so our total liability would be, we have our current liability first, which is this plus this plus this, which gives us 5.8. Then we have our non-current liability. So both liability. So a non-current liability of 3. So 5.8 and then 3. 5.8 and then 3. 5.8 plus 3. Okay. So this gives us, do you have 8.8 plus 6.3 gives us 15.1. So where's 15.1 minus 5.8 plus 3 gives us 8.8. Okay, so what do we have? Minus 15.1. Okay, so that gives us 6.3 million as our net asset. But we're interested in per unit. So the question says per unit. So we need to calculate what would that be per unit. So per unit will just be dividing that by the number of shares. Is equals to your net asset divided by the number of shares. So that's 6.3 divided by how many shares do we have in issue? Okay, so let's look at our balance sheet to see how many shares we have in issue. Okay, so we're going right back to the balance sheet for the number of shares. Okay, so we have 2.1 ordinary shares of 1 naira each. So also that means the total of 2.1. So 2.1 multiplied by 1 gives us 2.1. So divided by 2.1. Okay, so based on net asset historical basis, what do we have? 6.3 divided by 2.1 gives us 3 naira per share. Okay, any question on net asset basis. Okay, so just a quick one, like I said, your net asset could be your total assets minus total liability, or it can be share capital plus retained earnings. So if you wanted to calculate it with that, the second method, we just go back to our balance sheet and just look for share capital plus retained earnings. That should give us the same thing. So that would be the share capital here plus retained earnings give you a total of 6.3. And that's what we have here. That's what we have here at 6.3. We need to do this division because we need to find per unit. Okay, so we're done with the first one. Let's look at the second part is net asset basis revalued. Net asset basis revalued. So let's explain that quickly. So net asset revalued. The formula is the same. Total assets is equals to, sorry, net asset is equals to total assets less your total liability. Formula is the same. However, the difference is on where we look. In the historical cost, we're looking at the balance sheet. However, in the revalued part of it, we are focusing attention on the revalued amount. So we're looking at the revalued amount first. Where an amount has no revalued figure. So maybe sometimes they contract someone to find out what the market values is, but maybe it's just for some asset, not for all of the assets. So where it doesn't have an historical value, in other words, those particular values, there are no revalued amounts for them. We make use of the balance sheet figures. So where an asset or liability does not have a revalued figure, we make use of the balance sheet figure. Okay, so that's just something to bear in mind. So let's go back to our question. We're going to look at our total asset minus total liability. But because we're looking using the revalued approach, we're going to begin with the revalued amount first. So when we're done with that, we then look at any amount, any item that doesn't have revalued amount, we make use of the balance sheet items. So let's do that quickly. That's our P part, which is our net asset basis revalued. Okay, so let's begin with our total asset. It is our total asset. It is our total asset less our total liability. So let's go to our question and begin to pick our assets. So this is our balance sheet, which is what we use for the historical value. So we have free land, machinery, under here inventory, receivable, and cash, and then liability. Let's go to our notes to the account and see if we commissioned anybody to revalue some of those assets and what the value is. So the question here says that KL's management had some of the company's assets independently revalued in January 2023. These values are shown below. Okay, so these are some of the values. So the ones we have revalued amount, we're going to use it. So our freehold land is 8.3. Our machinery is 4.1. Our inventory is 3.1. Okay, so let me get into this revalued amount first. 8.3, 4.1, 3.1. That's on my asset side. So that's 8.3 plus 4.1 plus 3.1. Okay, so those are these assets, the valued ones. So let's see if there's any other revaluation in that note. If not, we'll just go to the balance sheet and pick the rest. Okay, so this is on price earning ratio, so that doesn't concern revaluation. This is the cost of equity, so it doesn't concern our asset or liability. This is pre-tax projected cash flow. These are estimated projected future cash flow, so it doesn't affect that. Okay, this is on equipment. We already have the revalued amount up on equipment, machinery, equipment. So, okay. So I think we don't have any other revalued item here. So for the rest, we make use of the balance sheet figures if we don't have any revalued stuff on it. So let's look at our other assets now. Our freehold land and building, we had used the revalued amount. Our machinery, we had used the revalued amount. So that's great. So we're going to our current asset. So these two, we use the revalued amount, so we are good. Let's go to our current asset. Our inventory, we had used the revalued amount of 3.1. Our receivables and cash, there's no revalued position. So we're going to use the balance sheet value. So that's 2.8 and 2.8. And what do we have here? Cash at bank. Let me be sure it's not clear at my end of my account. Okay, 0.3. Yeah. Yeah, so 2.8, 0.3. Let me just be sure that I didn't miss. Okay. Yeah, so 2.8, 0.3. Yeah, that's true. So let's bring that in, 2.8, 0.3. So plus 2.8 plus 0.3. Okay, minus our liability. There was no revaluation of our liability at all. I didn't see any of that in the question. So I'm just going to pick what it was for the historical one, because there's nothing to show that our liability was revalued. So we'll just pick what we use for the historical one, which is the balance sheet value, which were 5.8 plus 3 plus 3. So 5.8 plus 3. Okay, so what do we have? 8.3 plus 4.1 plus 3.1 plus 2.8 plus 0.3 gives us 18.6. Okay, minus, but let me double check that I didn't miss out anything, just to be extra sure that I missed out anything. This is looking 8.3 plus 4.1 plus 3.1 plus 2.8 plus 0.3. Yeah, 18.6. Okay, so 18.6 minus 8.8. What do we have? Minus 8.8. Okay, that gives us 9.8. Okay, so that is the net asset based on revalued basis. But we're looking at per unit, so we need to calculate the per unit by dividing that by the number of shares. So let's do the per unit. Same formula, no difference. So per unit is equals to our net asset divided by the number of shares. So that is 9.8 divided by 2.1, which is the number of shares here. So divided by 2.1. So that gives us 4.67. Any question on a revalued position? Please feel free to ask. Feel free to ask. If you have any question on that, feel free to ask. Sorry, I'm not seeing my mouse. Okay. Okay, guys. So that's our net asset revalued approach. So like I said, you start with what you have in the account that is revalued. If you don't have any item that is revalued, we then use the balance sheet amount. Please, very important that you take note of that. Our next one quickly is our price earning ratio. That's the next one, a price earning ratio quickly. Yeah, that's price earning ratio. So let's do that quickly. Let's look at what the value of the company is per unit based on the price earning ratio. So that's our number 3. Okay, our price earning ratio. Okay, so our price earning ratio is our earning per share multiplied by the industry average price earning ratio. And very important to take note of the fact that our earning per share is equals to our profit after tax divided by number of shares. So that's our price earning ratio for valuation. Okay, so let's go to our question and see if we can pick this information out. The earning ratio, earning per share, and the industry average PE ratio. Okay, so in the notes to the account, you might have noticed that they mentioned here that the average price earning ratio for listed businesses in the printing industry is 9. So they've given us what the average value is for the industry, which is 9. So our industry average price earning ratio, we have that from our question as 9. So this is 9. So that leaves us with the earning per share. So sometimes you might be given the earning per share directly. So the customer might tell you this is the earning per share. At some other time, you might not be given the earning per share and you have to calculate it. So in the question we just read, I didn't see earning per share specifically given anywhere. So if we don't have it, we need to calculate it. And that is our profit after tax divided by the number of shares. So what's our profit after tax? We need to go to the income statement. Income statement. Okay, so this is our income statement. This is our profit after tax. Okay, so this is our profit after tax. 4.4. Number of shares we'll be using it in our calculations before now. Ordinary shares, 1 naira each, 2.1. So that's 4.4 divided by 2.1. So this is 4.4 divided by 2.1. So our PE, the value based on the PE ratio would be 4.4 divided by 2.1 multiplied by 9. Okay, what do we have, guys? 4.4 divided by 2.1 times 9. That gives us 18.857. So that's 18.86. That's the value of P ratio. Let me pause a little bit. Any question on this? Okay. Now there's something you must note with regards to P ratios, dividend yield, anything that has to do with the stock market when valuing a company. The average P ratio we have used, the average P ratio we have used right now for our computation, let's go to our question, is based on listed companies. Okay, so let's go back to our question. The average P ratio we've used right now, where's that part of the question? Yeah, that's right up. All right, so the P ratio we've just used is based on listed business. And listed businesses, because they are listed on the stock exchange, their shares are easily traded, so they have that liquidity benefit. However, Kenny is not listed. So we don't expect Kenny to be appraised exactly the same way as companies that are listed, because Kenny is not a listed business, and that's why it has to use the P ratio for companies that are in that business. So we need to adjust whatever our figure is to reflect the fact that Kenny is not a listed business. Now, sometimes in exam question, the question tells you that you should adjust by 30% or 20% or 25%. Sometimes the question mentions it. However, where the question does not mention the percentage adjustment to make, you are required as a student to use your judgment to make that adjustment. So you need to use your judgment to look at what is an appropriate figure that we can adjust it to reflect the fact that Kenny is not listed. And for ICANN exams, oftentimes the Pathfinder will recommend a range of between 20 to 30%. So I can just put it a little bit because Kenny is not a listed business. We have to adjust. We have to adjust for this. So when the question gives you the specific percentage to use for that adjustment, please go ahead and use it. When the question doesn't give you an adjustment, you can use a range of between 20 to 30%. So that's what I can typically use in the range I normally use for the pathfinders. So sometimes you look at the question, you might see that they're using maybe 20%. Sometimes look at it, they're looking 25%. So it's just a range. So for this question, we can decide to use the maximum, which is 30%. So let's adjust that by 30%. So that would be 30% is 0.3. So that would be 1 minus 0.3, just adjusting it for the fact that Kenny is not listed, multiplied by 18.86. Okay, so that gave us that is 0.7 multiplied by 18.86. So that gives us 13.20 per share. 13.20 per share. Okay, all right. So that's our third method. So how many more do we have to go? Because I want to leave a few minutes for questions before we round up. So I could just, okay. So based on question 1, we've done, okay, so we have dividend yield and present value of future cash flow. And then the other ones are theoretical questions, which we can just discuss. Okay, so I guess here's a good place to stop. It's almost 11. The next class, we'll just do the last 2 within 30 minutes. Then we can move on to our next practice topic. So I'm leaving a minute or 2 for quick questions if there are any. So are there any questions on our approach to valuing a business when there are mergers and acquisitions using the methods we've considered? Any question? Or just any question, even if it's not on this that you want me to really speak to? Okay, guys. So if there are no questions, yeah, good evening. Thank you. Go ahead.
Please, this question is more of a business valuation in merger and acquisition. But I would like you to also look for a question that will emphasize on this synergy of a thing. Pure
Okay,
merger.
that's a good one. Yeah, that's a good one. Yeah.
I would like you to maybe look for a question that will teach us that one.
Okay, great. I love that, because really when you give me feedback, I'm able to also help you guys better, because I know where you have challenge. But do you have any question in mind? I can always get, but if you have a specific question in mind you're struggling with, we can just bring it on board and give it
All this combined targets company, when they want to any calculation there, I'm finding it difficult. Any calculation from that target company, combined company, acquirer, and all that.
Oh, great. Okay. But okay, that's great. Do you have any past question in mind? Maybe there's one particular one that's been giving you've been struggling with, so we can just solve it. If you have any in mind, if not, I can get one. But if you have one in mind, that would be great. Just share it to the group.
All right, so I don't have a particular one in mind, but I will look for one, maybe 1 or 2.
Great then. Great then. So that's a nice one. That's a nice one. So we will just onboard that into our practice as well. So just get 1 or 2 and drop it to the WhatsApp group that we use, and then I will just incorporate it into the plan, because like we said, mergers and acquisition, it's one of those top tested areas for our ICANN exams. But then sometimes when I get your feedback like this, I'm able to better realign my question practice based on the specific area that you have challenges with. All right, any other question, comment, or anything you want us to bring on board? We can have a few chats before we call it a day for our class. Okay, so if there's no other question, thank you very much, guys, for your time. We get going again, and Friday where we finalize this and then move on to the next question. All right, thank you so much, everyone. Enjoy the rest of the day and have a good week ahead. Thank you.
Thank you, sir. We really appreciate it.
You're welcome. Thank you.
Have a good night.